I'm your moderator, Scott Duda. I'm an audit partner in the Raleigh office of Cherry Bekaert. I also lead our professional services practice. I focus my practice on professional services and government contractors. With me today are Bryn and Eric. Bryn, can you start with your introduction?
Sure. Welcome, everyone. Thank you for joining us today. As Scott mentioned, my name is Bryn McNeil. I've been with Cherry Bekaert a little over 15 years now. I, like Scott, am in our audit practice and also a member of the professional services group. I also focus heavily on working with government contractors as well as A&E firms. So very familiar with indirect rates and also performing overhead audits. Eric?
Thank you, Bryn, and hello, everyone. My name is Eric Poppy. I'm a senior manager in the professional service practice, but also I focus also a member of the government contract services group practice in the advisory service arm. I help out a lot of times with anything regarding indirect rates and FAR compliance, and will be brought in situations where A&E firms might have questions about their indirect rate structure. Excited to get going today.
So what we're going to talk about today is the purpose of indirect rates, the composition of total cost, consideration of rate structures, the strategic implications, and here we're really going to get out of the numbers and really talk about strategy. Audit considerations, and so we're going to talk about how we as external auditors set our risk assessments and give you some insight there into how we approach the audit. Other audit considerations, and then pitfalls and best practices. So before we get started, we do have a chat function. You can feel free to submit questions. As they come in, I will bring those to Eric and Bryn, and we'll address those throughout the presentation. If for some reason we get to the end of the presentation and your question hasn't been addressed, we will follow up. And if you are not viewing this webinar live, please submit those questions, and again, we will follow up directly with you. And so with that, we're going to go ahead and get started.
So what really is the purpose of indirect rate for an A&E firm? First and foremost, it's really to recoup indirect costs, and just to make sure we're all on the same page. And for those of you that may be newer to the industry, indirect costs are those that cannot easily be allocated discretely to a single project or across projects. An indirect rate describes the mathematical ratio and its logical relation of indirect costs, basically the numerator divided by the quote-unquote base or the denominator. In this manner, one or more pools of indirect costs can be allocated basically in a mathematical way to all contracts and projects. The framework for all of these allocation methods and for indirect rates can be found in FAR Part 31. In a simplest example, a single indirect rate consists of all indirect costs divided by all project costs, commonly called direct cost. This is the logic for every dollar you spend on a project. You would apply this indirect rate to the project dollar to receive its calculated share of the indirect cost pool. An indirect cost rate schedule is the primary document that is used to show the calculation of indirect cost rates for A&E firms. An A&E firm's indirect cost rate is a critical element of A&E contracts. Ensuring that the indirect cost rate is properly calculated and contains only allowable costs is both a complex endeavor, and it requires a great understanding of the applicable regulations, principles, standards, and guidance. This indirect cost rate is what will be used to procure your A&E contracts and subcontracts. Having an approved indirect rate alleviates the need for an A&E firm to have to produce any supporting documentation or really much supporting documentation when you're working on contracts or subcontracts that are in states beyond your home state.
So indirect costs are important no matter what type of contract type, but depending on the contract type or how the contract is awarded, there can be even more emphasis on the calculation and the allocation of indirect costs. When the government or state does business with a company, a contract is awarded for a product or service that the company will provide. It could be for an actual product, or it could be for a service. Generally, the concern for the government or the state is, what is the actual cost of product for that service that will be provided, and what is the makeup for that total cost buildup. So if the contract is competitively awarded, there's less emphasis on what that price is because there is less concern on excessive price. Because if it's competitive, the market then has been able to drive down that cost due to adequate competition. But for very large business, so if you're a very large business and you do a significant amount of work with the federal government or state, and it's all competitively awarded, there's really no concern about indirects. Indirects might be required, you still might be calculating it to help with any cost buildups or for estimating purposes, but the worry of the audit side is a little bit less of a concern. However, the real question is the total costs. And if the contractor award is not competitive, then the question on contract type and becomes more of an emphasis, and that's where indirect rates come in. Depending on the contract, fixed price, is a lump sum typically. Time and materials is based off of an hourly amount. And then cost type is exactly what it sounds like for an award. It is based on your total composition of cost. Now, depending on award, you could get a mixed bag. You could have different contract line items, different contract types on those different contract line items in a single award. There could be some, exotic type of contracts where it might be a fixed price contract, but there are progress payments, or there might be an incentive type contract. Indirect rates might become more important if there is some type of change order, or if there is a claim of some sort or request for equitable adjustment.
Yeah, and just to add on to that, Eric, and to kind of come at it more from the audit perspective. So the level of risk for our purposes of an audit does vary based on the types of contracts that an A&E firm has. So let's use a couple of examples. So if an A&E firm uses primarily fixed price or, as Eric mentioned, some contracts, we're going to place more emphasis on the A&E firm's estimating procedures and the controls that they have in place to ensure that there are no direct costs in indirect cost pools. Conversely, if you're an A&E firm and you primarily work on cost plus contracts, the emphasis is going to be more on cost allowability. And if all the costs recorded in this accounting system reflect actual costs, regardless of whether such costs are billed. If an A&E firm has a mix of both fixed price and cost plus contracts, there's more emphasis on a consistent allocation of the costs. So the relationship of your A&E firm's government contracts to total contracts and the mix of government to commercial, that really does impact our audit perspective and the risk that your firm has.
So I think what you all are saying specifically is that details matter. Depending on the type of the contract, the details matter. Eric, can you go into detail of how and why that's the case?
Yes, thank you, Scott. So the composition of total costs, and depending on that procurement type that we were just talking about, really leads to what your potential cost recovery might be. So if it is a cost plus type contract, or if it is a T&M, or might be a sole source fixed price, depending on that award, there is more of a concern of the types of expenses that make up that numerator and denominator for the rate. And why is that? It's because your contract cost equals what you can bill and your cost recovery, and that is all based off of your GL and your records. And the composition of that total cost needs to be consistent with your cost accounting practices at your company, and also any applicable cost principles. So for many companies listening, it's typically FAR Part 31 for A&E firms, or if you do work with the federal government. So diving in a little bit deeper, when we talk about total costs and that composition of total costs, there are two major cost categories, and we're going to break down what makes up the total contract cost, which leads to your indirect rate calculation. And we're going to get into some definitions here just to make sure we all are on the same page. First, we have our direct costs, and our direct costs are program specific, contract specific, customer specific types of costs that are identifiable to a single cost objective. So when we talk about direct costs, the way that I always think about it is, if you did not have that project or contract, that cost would not be incurred. So if I do not win this certain contract, I would not then incur labor for that contract. So one for one. Now, indirect costs are the opposite. Indirect costs benefit multiple cost objectives. So they can be costs that are, supporting multiple contracts, multiple projects, and support maybe the organization as a whole. But it's hard to identify exactly what that cost is and what it can be identified down to. So breaking this down even further, and when we talk about the composition of total cost and what that cost would be for that project itself, you can see here that you have your total cost, and then we have those two buckets that we talked about, your direct cost and your indirect. Now, your direct cost, you have your different cost elements that make up the direct cost. Direct labor, employees working on the contract. Direct materials, items that you need to create and manufacture or produce that product. Direct subcontracts, labor materials that you are taking, that you have subcontracted out. So you've taken this piece of the statement of work and sent it to another party to complete. Other direct costs could be direct travel, direct consultants, maybe some specialized tooling. So, but those are the major categories of different direct costs. That's more of a one-for-one relationship. The other part of the total cost computation are your indirects. Those can be your fringe costs, payroll, health insurance, and such. We'll get into these in a little bit more detail in a moment. Overhead expenses, could be line management, PMO type costs, training, support, or it could be your G&A expenses, general accounting, legal, IT, those types of costs that are to support the running of the company. And then the last piece is profit. And that is then tacked on, depending on your contract award and the terms, to that total cost to then create the total contract price. Now, I joked that the last piece was profit, but we also have to consider potentially allocable credits to that contract. We'll get into that in a little bit more in a few slides from now, but especially now with being with COVID-19 that's going on and with PPP and the CARES Act and such, there's a little bit more of a concern about credits, and we'll get into that in a moment, but you do have to account for any allocable credits to that contract. One thing I want to point on this slide is that all these costs, your direct costs and your indirect costs, all need to be able to tie back to your GL or to your accounting records. So all of this, there would be an expectation that you would be able to tie this back to the GL. Next slide. So when we're talking about indirect costs, a lot of people just think of the computation of indirects as part of that year-end process, a closeout. I calculate my rate at the year end, it gets audited, good to go. But really, that rate is part of a whole indirect rate cycle that should be that needs to be considered, because there are different types of indirects and there's different application, all coming from that very similar computation. So I'm going to start with, when we're looking at this slide, the blue slide or the blue circle, negotiated or audited determined rates. So I'm going to start there. We're going to work our way around. So a lot of times at year end, you put together your final rate, then it gets audited. It gets determined that it's final. So people are like, okay, we're done with indirect rates for the year. Well, no, that's not necessarily the case. That rate is typically then used for forward pricing and for estimating practices. So we go up to that green circle. Those forward pricing rates can be used to estimate firm fixed price contracts, or it might be part of the T part of a T&M, or it could be for any long contract period estimate that's put together. A lot of time, those forward pricing rates are used to help put together our provisional billing rates, going down to the gray circle. Those provisional billing rates are used for billing on our cost plus or on our T&M contracts. Sometimes on a T&M contract, we can apply maybe G&A or some type of indirect on top of it. Or you might see this as part of your progress payment calculations. Those provisionals, as the year goes on, will be accumulated, and as the year goes on, you'll be collecting your indirect costs based off your cost accounting practices, and you'll end up being able to create year-end rates based off of actual experience on the contracts. Now, these rates are before the audit. you would typically then take those year-end rates, and after reconciling, making sure you take out any adjustments necessary, you would then put together your rate package for potential submission to whoever you have to submit it to. Typically, it's the federal government, might be a state government, might be a large funding source, and you would put together your rate package. So for a lot of our government contractors, you would put together your incurred cost submission, or your final indirect rates. And then that again leads up to where we started of our final determined rates. So a couple points I want to make, and some of these are best practices when you're thinking about the rate cycle. First, we go through this estimating process of what are our forward pricing rates potentially, what are the out years going to look like, and what really though is a lot of times people are looking at 1 year ahead. Where are my rates going to be next year? And then we get to that year, and now we've used those that prior look to make our provisional billing rates based off of current budgets. During the year, there should be an active step to monitor your provisional billing rates to actuals to try to address any major fluctuations in those rates. So you can kind of get ahead of the curve if there is a large fluctuation in your actual rates versus your provisional. The reason why this is important is that you don't get into a situation where you might have overbilled a customer by a significant amount where it matters based off a contract type. So for example, say that you win a very large award and you had to bring on a ton of new people into the company. They're all direct, so they would go into your denominator. Well, in that situation, your rate might drop. Well, if that's the case, you might have a provisional billing rate that's higher, and now our rate actually has dropped significantly, so you might be in more of an overbilling type situation that you might want to address. As the year goes on, if you're monitoring, you might be able to catch these things and address it sooner rather than later. At year end, though, you go through a big look back exercise, and you might want to try to address some of these billing items if necessary. Next, we would take those. Again, we go to prepare net incurred cost submission and that final adjustments. There, we might be doing any scrubbing that we need to do to address unallowables or credits. And then finally, once that gets audited, would start to prepare any final vouchers based off of those final negotiated rates.
So now we're going to talk about considerations specific to A&E firms. But before we do, we did have a question come in. The question was, can you clarify the difference between provisional and forward pricing rates?
Yes, great question. We get this a lot, actually. So forward pricing rates are used for estimating and budgeting, or for estimating practices. It's a pricing exercise for your contracts. It is typically for a more than a year period. Typically, we see 3 to 5 years, commonly 5 years. And you would submit your forward pricing rates to get a approved forward pricing rate agreement. What this is this states that you can use these rates for estimating putting together your proposal package and estimating in the out years. Forward pricing rates take into effect indices, other escalation, out year budgets, and maybe changes in considerations of potential wins in calculating your indirects. Provisional rates in a provisional rate agreement, or approved provisional rates is another way to put it, is just for billing purposes. This is what you can bill for this current year. A lot of times people will kind of use the two terms interchangeably, but provisional rates are for billing, forward pricing rates are for the estimating.
Perfect, thank you.
So now we're going to go into additional considerations for the indirect rate structures for A&E firms and kind of how the indirect rate is truly built. So fringe rate and fringe benefits are a critical piece of the indirect rate. Fringe benefits are defined as part of FAR Part 31 as the cost of vacations, sick leave, holidays, military leave, employee insurance, and supplemental unemployment benefits. For purposes of allowability, fringe benefit costs are allowable to the extent that they are reasonable and are required by law, an employee-employer agreement, or an established policy of the A&E firm. Fringe expenses are incurred for the benefit of all employees, regardless of whether you're direct or indirect. We've included several examples of different fringe benefits on the slide above, but I also wanted to mention a few additional fringe benefits that directly impact the consideration of executive comp, which is a key piece for A&E firms in reviewing for unallowable costs. And those additional fringe considerations as it relates to exec comp would be your deferred comp plans, pension plans, if there's the ESOP expense, severance pay, and then supplemental benefits. You know, if you have supplemental executive retirement plans, if you have long-term incentive plans, or if there's an executive severance package that's available, those would be other fringe benefits that would have additional consideration when you're looking at exec comp. So certainly something we wanted to bring about as we're talking through fringe benefits.
So when talking about fringe benefits and the fringe rate, a lot of the government typically considers the fringe rate one of our least volatile rates, and typically it is because our costs are pretty consistent. We can plan for that. Now, when a lot of times the fringe rate or the fringe benefits might be absorbed directly in the overhead rate. So if you're sitting there right now saying, hey, I don't have a fringe rate, that's okay, because a lot of times it's just put directly into that overhead rate pool. There are some considerations when it comes to your fringe rate, though. As Bryn was mentioning, types of expenses, you know, severance, tuition, bonuses, health insurance, those dental insurance, those types of things. There can be some impacts on very customized, you know, if there's a customized benefit package, you know, so if you have a lot of veterans or versus retirees, or if you have a lot of part-time versus full-time, union versus non-union. So, if, you know, maybe if you have a Davis-Bacon covered contract, if you do some large construction type contracts, there can be a huge difference in benefit packages. This can also vary on geographic location. You know, some states might require certain types of benefits to be provided versus others, or if you're international versus not. So there are times where a company might have multiple fringe rates or multiple fringe rates, and if there is a strategic reason to do so.
So on the flip side, in the overhead rate, overhead costs are costs that may benefit or are associated with two or more business activities, but are not specifically allocated to an activity for reasons of practicality. In its simplest terms, overhead expenses are incurred for the benefit of the direct labor employees performing their jobs. Some examples of overhead are rent, depreciation, employment recruitment and training, and general other professional insurance policies, in addition to a few others that we have on the slide above.
Thanks, Bryn. So some overhead rate considerations that you might want to consider, and where there might be some differences and where you might have multiple overhead rates. Sometimes this can happen if you have, again, geographical areas. You have contracts or projects that are supporting, you know, one state versus another, or international versus not again. Sometimes you can have different overhead rates based off of product line or service. So if you have a manufacturing business unit, but then you have a more labor intent or more just labor-based business unit. Sometimes it can be off of function. So again, technicians, the example here is technicians versus software designers. Maybe it's architecture versus engineering. Then other pools could be where people are actually working on those contracts, maybe a home site versus a field site. So this is in this last bullet, and then the client site versus company site versus field. This is where we commonly see a lot of different overhead pools when it comes to A&E firms, is that there might be a field site versus a company site or a company office. You need to have the rationale on why you would create a rate, a separate overhead rate for a field site. It typically should follow where the people are performing the work, where they're receiving the benefit, what types of costs they're receiving benefit from. But there should be an equitable allocation between the two rates. And of course, make sure to document those rates. So another common type of overhead rate that we might see, and this will lead maybe into, you know, a slide in a few moments, But vehicle rates or machine or special machining rates, or maybe even tooling, sometimes those can be considered a separate overhead rate if there is a distinct benefit that you can allocate certain costs to. So to summarize, a lot of times for A&E, we do see, a field site versus a company site, but your overhead rate structure should match how your business is operating, and you should be able to rationalize and defend if you are creating two different overhead rates.
So allocation bases are used to distribute or allocate these overhead costs to the final cost objectives. An allocation base common to all cost objectives or the projects should be selected to allocate those costs. So most A&E firms use direct labor as the sole base for developing their A&E rates. Although some firms that have structures that are a little more complex and multiple allocation bases to allocate costs. The bases that we've included above, direct labor plus Fringe, direct labor plus Fringe plus other unit of measure, and then simply an other unit of measure. So just to elaborate a little bit more on what an other unit of measure could be. Typically, we see that either based on time or quantity used. So another common example that we see with some of our A&E firms is that they'll create an internal cost pool as one for computer-aided drafting and design equipment, or what most of you might be more familiar with, CAD. These CAD costs can be allocated specifically as a direct cost to a project or as an indirect cost based on the number of hours that are actually incurred. As Eric mentioned, once an A&E firm establishes what base they believe to be most appropriate for distributing indirect costs, the base should not really be fragmented by removing individual elements. So rate structures and your cost allocation methods really should be applied consistently for all of the contracts, including your state DOT contracts. An example that we can share, if an A&E firm has a single company-wide cognizant audited rate established, they should not then apply a segment rate for a contracting entity when the costs included in that segment rate are also included in that company-wide audited rate. So the allocation and being consistent there too is pretty critical.
So we had another question come in, I think based on the last two slides discussions. What are some best practices to allocate services that benefit many departments or contracts? Examples would be HR or depreciation.
That's a great question, and actually we're going to touch on that here very shortly. So it depends on what the true nature of that cost is and who is receiving the benefit of it. But typically some of those costs would be allocated based off of service centers, which if we go to the next slide. So service centers are a very easy way to allocate some very common indirect costs. Service centers, a lot of times you'll see this with companies a little bit more complex indirect rate structures, or if they are larger and have more of a centralized home office or centralized shared service center. So these are the types of costs that benefit multiple cost objectives. It could be allocated to a direct or indirect project. It provides a little bit more precision in the calculation of the rate. Common things, Scott, as you just asked in the question, human resources, recruiting, security, administration, sometimes some facilities costs or IT are common types of service centers that might be allocated out to those cost objectives. They're always allocated out based off some type of surrogate. So that could be, for example, for facilities, square footage, or for certain situations, it might be headcount or usage or labor hours. So for IT, for example, we've seen examples of companies allocating IT to those different cost objectives by number of user logins or computers issued to departments. Accounting sometimes, or even more specific in accounting, maybe the AP service center, if it's a very large organization, might be allocated based off of number of vouchers paid, things like that. It really just depends on the situation. HR, a lot of times it's on headcount or labor. So with service centers, again, it's an easy way to group like costs that benefit everyone and allocate those out to the cost objective. And those costs should be allocated out by the end of the accounting period and should be consistent with your accounting period. So a lot of times those service center costs would get allocated to your overhead and to your G&A. So first thing I wanted to address here is what really, again, going back to what the G&A rate is. The G&A rate is costs that are associated with overall running of the management or the company. So the G&A rate is different from the overhead rate or overhead costs, whereas as Bren was mentioning, the overhead costs are associated with the indirect costs that benefit the cost generating activities, the revenue generating activities, so the contracts. This is more running costs associated with running the company. Sometimes for A&E firms, the overhead and G&A might be combined together, be one single indirect rate. Sometimes, depending on your business unit or the size, you might have a separate G&A rate. It just depends on your cost structure. But if you do have a G&A rate, the most common way to allocate those G&A costs would be based off of a total cost input method, which in a very simple terms are all costs except your G&A pool. Another common way to allocate those costs might be a value added based method, which simply put is a TCI or total cost input method less your materials and subcontractor costs. If that's the case, you might have a material handling rate or a subcontractor rate if you're using a value added base. You know, the least common way to allocate G&A might be a single element base, might be direct labor only. In this situation, you typically have to get approval on using that base. Now we want to get into some considerations for that G&A rate.
Eric, before we leave this slide, we had another question come in. It's, are we required to have a G&A rate?
No, you are not required to have a G&A rate. Depending on who you're performing work for, there might be situations where it is more common to see a G&A rate. But as I mentioned a few moments ago, the G&A rate sometimes might be combined with the overhead rate. And if that's the situation, what I'll say is your indirect rate structure should reflect your current business environment. So in any audit that would come up with a state auditor or a federal auditor, they're going to expect you to be able to rationalize why you have your current rate structure. If you have a G&A rate versus an overhead rate or one combined indirect rate, that would, you just need to be able to defend why you have that structure.
Perfect, thanks.
So a few more considerations with the G&A rate. Sometimes, especially for larger organizations, there could be multiple business units that use that might have single G&A rates. It really depends, again, on your current business makeup and how you might be allocating those costs. Then, as I mentioned before, there might be a value added base that you're using to allocate your G&A. That might be considered if you have, again, a material handling or subcontractor rate, where you are siloing off the costs that are used to manage your materials and subcontractors, and you're allocating those based off of probably purchased materials and subcontractors, and you are then excluding that from your G&A rate computation. Also, within your G&A rate, there might be a situation where you have corporate allocations that are being allocated down from a corporate home office. You know, you need to be able to just document and state what that allocation method is, and also consider unallowable costs in there too. And then lastly, unallowable costs. Any unallowable costs associated to a direct project or a billable cost that's associated to a direct project, or unallowables that are part of your overhead pool should be included as part of that G&A base, because the idea is that even those unallowable direct costs or unbillable direct costs still receive some type of benefit from that G&A rate. So I wanted to talk a little bit more about the treatment of corporate allocations, which we talked a little bit about in that last slide. But a lot of times, these costs coming from a corporate home office are being allocated out to multiple business units. So they could be absorbed in multiple overhead rates or maybe into your G&A rate. A lot of times for A&Es that have multiple overhead rates for each business unit, we'll have these costs allocated down to it. So the way that these should be treated for, and this is part of the AASTHO guide, it talks about, considering CAS coverage and consider FAR Part 31 and how you allocate your costs. The way that we think about, we can go back to the last slide. So there are 3 ways to allocate your corporate allocations. First is direct allocations to 1-for-1. Those are the easiest way to allocate your costs down. If you have insurance for one single contract, or you had a legal fee for one single contract, you would allocate that down to that overhead. Homogeneous costs are kind of like service centers. You're grouping corporate costs and allocating them out based off of some type of surrogate. So it could be headcount, revenue, something along those lines. Then lastly is the residual costs. These are all the costs that are that you can't allocate either directly or through a homogeneous cost pool, and you would allocate out typically on the 3-factor formula. A lot of times this is C-suite, some corporate administration costs, but it's really hard to identify it down. Now, lastly, before we get into talking a little bit more strategy and out of the computation, I wanted to talk about the next slide, which is credits. Now, if you remember back to the slide that we talked about, the total composition of costs, there was one box that had credits in there, allocable credits. We wanted to mention this, especially right now, because part of allocable costs and part of your computation of your rate, you need to consider if there are any credits that you need to take out. The FAR clause that talks about credits is 31201-5, and the definition is the applicable portion of any income, rebate, allowance, or other credits relating to the allowable costs received by or accruing to the contractor shall be credited to the government either as a cost reduction or a cash refund. So there's been a lot of guidance that's come out recently about PPP and the loan forgiveness. So there is an expectation for a credit to be applied as part of your indirect pool for costs associated to PPP. We wanted to bring this up just because it's so relevant right now. And this impact could, again, impact your organization more based off your contract type. And we want to just mention that you should be trying to actively monitor your indirect rates and that create the documentation to support any of these credits applied or any adjustments that you made.
So now that we've level set and we've talked about definitions and calculations, we really want to move to strategy and the strategy behind creating your rate structure. And really what we're talking about here is maximizing the 3 elements that you see on the screen here. The management tool, the rate can be used as a management tool, and so we want to maximize that. We obviously want to ensure compliance both with the FAR and with our contracts. And then we want to maximize cost recovery, obviously. And so the strategy that you implement should be one where we really maximize all of those elements. And so we'll get into some details on those now.
Thank you, Scott. So when we talk about these two different buckets of a management tool and maximizing cost recovery, I'm going to start with management tool when we are using indirect rates in a strategic manner. So when we talk about management tool, it really should be part of the decision-making process. You really want to know how much something is going to cost and how much then you could potentially sell it for and where to potentially make future investments into that process. Using indirect rates can help also validate your budgeting process. It helps to manage plan performance versus actual performance. and it also helps you identify the costing relationships and to see where there might be a problem. So, what's our fixed versus variable relationships? Where could there be some more flexibility? Which leads us to the maximum cost recovery. Now, the piece here is it helps to ensure that all costs are included and tied to your general ledger, and helps to prove in the event of an audit that there is an equitable allocation and that those indirect rates really benefit those certain cost objectives. It also, could help from a competitive standpoint and help show a competitive presentation that, your rates are an integral part into the cost estimating process. It helps to prove that those are the true costs for any product or service. And it should really design to reflect the organization and to make sure that you have, optimum cost recovery when you are pricing and then when you're billing your work.
So we talked originally about looking at the audit considerations as well. So we want to get into those here, whether it's cost principles, everybody's favorite cost accounting. We're going to talk a little bit about the auditor's perspective, where we focus on high risk accounts and transactions, and then internal controls and labor charging. This is obviously an area that, especially as firms are beginning to develop rates, the labor area is one in particular where we will oftentimes see some issues with internal controls. And so we want to address that specifically. And Bryn, so if you can give us some details here on these items.
Sure. So we'll start off with the cost principles. So state DOTs rely on the FAR Part 31 for guidance when negotiating costs and reviewing project proposals for A&E firms. The FAR contains all of the cost principles and the procedures for pricing contracts, subcontracts, or any changes within contracts. That's really why these audits are focused so much in consideration of FAR Part 31. One thing we did want to point out is that although FHWA regulations require state DOTs to accept indirect cost rates that are compliant with FAR Part 31, and that they also are required to accept the cognizant audits of FAR compliant indirect cost rates, those are only applicable to contracts that involve federal funding. For contracts that don't have any federal funding, some state DOTs and local agencies can actually define allowable costs a little more restrictly than just the FAR Part 31. And we certainly have a number of A&E firms that we work with that do work in other states, and those states do have more restrictive guidelines. So examples of costs that might be restricted by a state can include travel costs, selling costs, compensation in excess of locally established ceilings, or even limits on incentive compensation. So it's really important that when you're doing work in another state or with another state DOT that you're conscientious of if they have set per diem rates that they are following. So some state DOTs also have cost accounting methodologies that vary from methodologies normally applied and what your A&E firm might typically use for especially federally funded contracts. Some have specific rules or policies for overtime premium, as an example. So the allocation of how they charge overtime as a direct or as an indirect cost could vary. I know we've got another client that we work with, and that just kind of came to be very recently out with a state on the West Coast. When an A&E firm does have adjusted rates for maybe some of these state local restrictions, those adjustments or rates should be disclosed through the notes to that indirect cost rate schedule. So you don't necessarily have to adjust or make an indirect cost rate schedule specifically for that state, but you do want to make sure that that note, there's a footnote within the notes to those. Cost elements must be reviewed for reasonableness, and reasonableness concerns can arise from a number of cost categories. So indirect labor, fringe benefits, pretty much any of the cost categories that you're reporting on within your indirect rate schedule certainly need to have an element of reasonableness and allowability. So a cost is allowable when the cost complies with all of the following requirements. So it needs to be reasonable, allocable. If you're following CAS, it needs to be following the CAS standards, and then certainly the limits and terms of the contracts. For a cost to be allocable, it needs to be assigned or charged to one or more cost objective or cost center, and it's really based on the relative benefit that's been received. In the sense of unallowable costs, any costs that are expressly or mutually agreed to be unallowable should be excluded from your indirect cost rate and therefore not included as part of your costs that are allowable on your cost structure. I know I mentioned the CAST standards, so the cost accounting standards. Contract may be subject to CAS. So an A&E firm just really needs to make sure that if you are subject to full CAS coverage, that you are following those practices and your respective disclosure statement. I know we mentioned the allocation basis. We said before, in A&E firms, most common is to use direct labor as a basis for allocating indirect costs. And the base period for allocating these costs should really be that 12-month reporting period. So now I'll finally get to the cost. Sorry, Scott, I had a lot on that cost principles. So now we'll get to the cost accounting and go a little bit more detailed on here. So for cost allocation, as we've discussed before, allocation bases are used to really allocate your overhead or indirect costs to the final cost objectives or projects. For A&E, as we've said, the direct labor is the most consistent one that we have. Talking a little bit more as cost centers, I know Eric touched on this as well. So cost centers are established to accumulate those costs with a single purpose. The costs are then assigned to those projects based on the unit and consumptions. And many of our A&E firms that we work with do have CAD in-house rates. And really, when you're using that cost center, the goal should be to estimate that unit charge that will minimize any of those variances that you do have with those costs. It is more common for, I think, the cost variances to be handled as an adjustment. That's what we see the most, to an overhead cost pool, which is where the cost would have been allocated if they have not been directly assigned to that cost center. Getting into internal controls and labor charging. When performing these audits, and anytime that you're doing work with a state DOT or a government contractor, it is essential for firms and companies to maintain an operable accounting system under a general ledger control. So there are some key controls and a properly designed system that we always encourage our client and any company to follow. Proper segregation of direct versus indirect costs is key. Being able to identify and accumulate direct costs by that respective cost objective or contract. A consistent method for allocating indirect costs to those final cost objectives. Accumulating all of the costs under the GL. And then a timekeeping system that really helps to identify where the employees are charging their time and if they're going to the final cost objectives. A labor distribution system that will help charge between your direct and your indirect labor. The kind of key piece here and key link between having the accounting systems and labor charging systems, though, really gets down to that individual employee. So it's critical to labor charging internal control systems that management also really involves the employees and ensures that employees understand kind of their independent and their own responsibility for accurate time charging. So time card preparation is a key piece for labor charging internal controls. You may have an automated timekeeping system. You may have a manual timekeeping system. Either is perfectly fine. You just want to make sure that regardless of what kind of timekeeping system you have, that there's accurate and current recording of your hours by the employees, and also that there's controls in place to make sure that those hours that the employees are charging are accurate and authorized. A key policy here that we will always take a look at, and have also helped a number of clients or companies write, is the timekeeping policy. It's really critical to make sure that this is one. So we sometimes get in there and they're like, oh yeah, we have this policy, and it's actually not relevant for what the system and what the employees are actually doing on a day-to-day basis. So keeping that timekeeping policy updated, but really getting back to, are the employees using their time cards? And more importantly, are supervisors approving and signing those time cards? That's really critical when it comes to reflecting your hours and your timekeeping. There is within the AASTHO guide, and something that we also certainly use as part of the audit, but it's a labor charging checklist. It's in, I believe, chapter 6 of the AASTHO guide, and that will go through both system controls. So is there really that segregation between timekeeping and payroll, for example? Then it also goes through more specifics on timekeeping in the sense of the preparation of their time cards, as well as looking at that policy. So it's a really good checklist and a base to kind of look at as you're developing those controls and also reviewing those policies. So thinking about the audit and kind of from our perspective, we're working with and helping A&E firms, there are some more high-risk accounts, and even in the AASTHO guide, there's selected areas of cost that we really focus on. Executive compensation and bonuses is an area where it's the documentation and the policies, whether you're using the national compensation matrix, or if you're using surveys, making sure that you're not just getting one survey, you're getting multiple surveys, and then making sure that when you're reviewing the calculations with unallowables, you've considered all elements of compensation. For travel and employee expenses, the key here is making sure that you're really following where the employee is going. You're following those per diem rates based on the locality that they're in and they're working in, both for hotels and for hotels and travel, as well as how they got there. Is it through mileage? Was it through airfare? Maintaining those logs or those receipts and those approvals there too are pretty critical. For vehicle expenses, a lot of A&E firms have both company-owned as well as personal vehicles. And this has been a very hot topic for a number of years now, making sure that these vehicles expenses are not being charged both as a direct cost to the contract as well as included in your indirect cost rate. So really making sure that there's no double dipping between the two, and that there's also really adequate documentation to support those personal vehicles that are being used. Consultants and professional services, this is an area we get in there. We always see it to be a little bit more vague in the sense of what was really going on here. So I think really truly trying to get an understanding of the folks that were involved in some of these professional services, or working with the consultants, having them really help support the accounting team to understand what was the makeup of the services that the company was doing. Are those truly allowable costs, or was there any component that was lobbying, for example, and should be allowable? So I think working with the employees beyond just the accounting team is really critical when you have a lot of consulting or professional service related activities. And then it's always, in the term itself can be very vague. So I think truly trying to minimize those costs that are just getting flushed through a miscellaneous account, and really being able to better classify where your indirect costs are going, and so that they can be appropriately captured. At the very bottom of the slide, just to not discount it, but anytime you have directly associated costs. So a great example, and something that we see commonly when you're doing your travel and employee expenses, if someone stays in a hotel and the per diem rate that was in effect for that locality relative to the hotel rate that was charged, if the hotel rate was in excess of that per diem rate, the company did a great job of disallowing that piece of it. But don't forget to also then apply that same percentage to the taxes. The taxes of that hotel stay are a directly associated cost, so those also need to be considered unallowable. And then we did include just a few points. These can be a little bit more complex in nature, but anytime there's a merger and acquisition, there's a lot of disallowances that are associated with those, and sometimes it's not as easy for firms to be able to produce, here's all of the costs we incurred leading up to this acquisition. So really trying from the very get-go to make sure that that's on your mindset and that you're really tracking those costs and the people that are involved within that. For rent, if you've got multiple buildings and there's any ownership of management in one and then rental from another there too, common control considerations are very common with a lot of our clients and a lot of A&E firms. So making sure to truly understand that very complex area of the FAR. And then idle space, I think, is going to be an interesting one, especially for this year, given how many companies may have employees that have been working from home for, 8-9 months of the year. So giving consideration to any idle space the firm may have that truly is sitting there unoccupied. And then Eric touched on the corporate or home office allocation. This will also be a more complex area for a number of firms, but making sure that the home office allocation is thought through, is consistent with any disclosure statements. And it's certainly an area that we help a lot of our clients with because it is a little more complex.
All right. Thank you, Bryn. So we wanted to talk for a moment about 3 other systems, actually. A lot of the items that Bryn just went through when it came to those controls and those different accounts and some of the practices and policies that you should think about and have really also bleed into different accounting or into different systems within the organization that could impact your calculation of your indirect rate or use that indirect rate. So we just wanted to mention briefly that, especially if you have worked with the federal government, the indirect rates and the allocation of those indirect costs and identifying direct versus indirect really impacts your accounting system and getting an approved accounting system. It also impacts how you might be pricing and estimating, which should hit your estimating system. And it also hits your purchasing if you're making purchases and you are buying any non-labor type activities or even labor too, and those are components into either the numerator or the denominator, that could then impact your purchasing system. So we just wanted to bring this up. We're not going to go in depth about the accounting, estimating, and purchasing system and how the rates play in, but we wanted you all to be aware that it does impact these systems. So if you have any questions, please feel free to reach out. But there are some other considerations and audits that might occur that could impact your indirect.
So we just thought it might be beneficial to bring up a couple of audit pitfalls that we've certainly seen with working with A&E firms and companies, and then also provide a best practice. So inadequate timekeeping. So the key here is just making sure that you're really training your employees and that you have good documentation of timekeeping records. So those timesheets are critical to maintain and to have, and ensure that timesheets are accurate, signed, and approved. Incurred unallowable costs. So identifying unallowable costs at the point of entry into the system is critical, but it does require training, an understanding of what unallowable costs are, as well as an internal control environment where you've got management reviewing this. But as opposed to having, every A&E firm at the end of the year is always going to have to do a scrub. It's not like every single cost can just be categorized into an unallowable right away. But that at the point of entry that are expressly unallowable, that can be just flagged and identified as such, the easier that it is when you're doing that scrub at the end of the year. Inadequate audit evidence. maintaining those formal supporting documentation. So what we're really talking about there are those invoices, your expense reports, your receipts, making sure that you not only have the invoices to support the cost, but there's also been that control. Was that invoice reviewed and approved? Does that cost really relate to the right year? Having that support is critical when it comes through to getting an audit. Incomplete documentation, I feel like I sound like a broken record when I'm out there with many of my clients and A&E firms, but having formal and complete policies and procedures, it's great to say, oh yeah, we did this, but without being able to truly support it with a policy or procedure, it's really hard from an audit perspective to be able to verify, yes, that's correct. And it's certainly an area where, we provide a lot of recommendations from, and it's always just, well, can you produce the policy, please? So I know it's a little bit more work, but certainly critical as it comes to the audit.
One thing to add, Bryn, when it comes to inadequate audit evidence, if we see this a decent amount with companies that might have shared services agreements between a related party, or if there are any internal work orders or shared labor, having evidence of documentation of how you're allocating and splitting those costs a lot of times comes up as necessary and needed to get through that audit. So just wanted to mention that because I've been seeing that a lot coming up in audits. Yeah,
that's a great point, because truly for us, if we can't see that audit evidence, it's really hard then for us to be able to, at the end of the day, say, yes, we concur that this is an allowed cost. And unfortunately, that can lend to having to put a disallowance on it, just for purposes of not being able to actually support the cost.
Great. So we are sharing here on this last slide our contact information. I'm looking through the chat. I believe we've addressed all of the questions, but we'll leave it open here for another second or two. If you've got anything question-wise that you'd like us to respond to, please put that in the chat. Otherwise, feel free to reach out to any of us with any of the content that we discussed today. We'd be happy to answer any questions that you all may have. For those of you that may be viewing this in a recorded fashion, again, please submit your questions and we will follow up with you directly. I want to thank Bryn and Eric for sharing their expertise with us today. Very informative and really appreciate that. I don't see any additional questions coming through, so I want to thank everyone for joining us today. Hope you found it very beneficial and appreciate the opportunity to speak with you today.